It is about the NASDAQ yet again today. Modest gains. Nonetheless, we are in the green. Other areas are in the red. The NASDAQ is extending those record highs up 3.5% just about this week. Retail is getting more engaged. According to JP Morgan's Retail Radar, retail buying in tech reached a one-year high. That's notable. JPM says there's also room for the pros to get more involved. They say institutional investors and in particular macro managers have room to further increase their equity exposures from here. And there is bullishness abound. The billionaire investor and the philanthropist Paul Tudor Jones was on Squawk Box this morning, gave his take on this record run. Watch.
I kind of think Claude Code, January of this year, would be the equivalent of when Microsoft came out in 81. And then 95, we kind of look at when we finally allowed the internet to be used for commercial purposes. I think that was May of 95, and then Windows 95 came a few months later. Those were both the beginning of productivity miracles that lasted 4 to 5.5 years. We're kind of, I'd say, 50 or 60%. If I had to pick a period, we've got another year or two to run.
All right. There's PTJ talking about runways, as I think a lot of people are thinking about, looking at these incredible moves that we've had and thinking about how much is left. And he says a lot. Says a lot.
Well, you've got the big stocks back in gear, and this is very important for sentiment. We have seen markets rally without those stocks. We know that can happen, but what we also know historically over the last 10 years, when the big stocks that everyone owns that drive index performance, that are widely held, when those names are moving, and not just moving, but making new highs, as is the case with some of the biggest blue chip tech companies, it really does do a lot for sentiment, and it absolutely drives increased retail flows, which are obviously important to the tape. So it should not be a shock. I also think one of the more positive stories that we see right now, the beaten down software names are leading the rally. And that's really exciting for people.
4 straight weeks of gains for the IGV. That's what we're working on. And that is, to Josh's point, and I'll give it back to you in a sec, the longest streak since September. So there is life again. Now, there are a couple of stocks we'll get to in a moment that are leading the charge today, but your point is well taken. This area that was so beaten down has woken up.
Yeah. Look, the leadership group obviously has been anything even tangentially related to the AI CapEx build out. That's where people have been making money all year. But we understand that when you get a group of stocks where they're about to start reporting earnings, or in some cases they have reported earnings, and these stocks are at a 20 to 40% discount from their prior highs, like these software names, when you get a group like that back in gear, obviously led by Microsoft, but even looking at non-mega cap software, large cap, even mid cap, when those names start to move higher and people feel some relief in that portion of their portfolio, I do think it helps the animal spirits overall. And if you get a little bit of a pause in the semis, get a little bit of a pause in the AI CapEx build-out names, that's okay. Many of those stocks have just doubled. So I like that the ball is being passed and people are starting to re-engage with stocks that we haven't been talking about for a long time as being winners.
Sorry. Let's have a conversation, guys, about durability, which is very much what Paul Tudor Jones is talking about, versus fragility, because they're two interesting points of conversation, I think, and it's how the FT is addressing this story today. Yes, it's been all about carry AI. The question is it too much about AI and nothing else? As they point out, Wall Street's rebound since late March has been driven by the smallest number of stocks on record, pushing the U.S. equity market concentration to an all-time high and prompting warnings about the fragility of the rally. Just 5 tech stocks, Alphabet, Broadcom, Amazon, Nvidia, and Apple, have accounted for more than half. Okay? Just 5 tech stocks have accounted for more than half of the S&P's recent gains. Issues or not?
Well, definitely. Whenever we've had this before, we've had a situation, as we saw a couple of months ago, that an event such as the beginning of a war can hit the market hard, or there's a fleeting away from names that have had these enormous runs. That, however, does not mean that they don't recover, which they've recovered. We've had a series of setbacks to the market over the last few years where the leadership, which has been these concentrated tech names, Mag 7, 5, 4, whatever, they take a hit because they got overheated, and then they come back. And we had expected them to come back because they started to lag the S&P in terms of multiples. You know, you were getting many of them selling at market multiples or lower. You still have a couple who are. And that meant that there was an opportunity. Does it mean it's over for them? Absolutely not. Does it mean they can take a rest?
It feels like anything but.
Yeah, they're very, very hot names.
Look at the gains since the March 30 low, stacked for the stocks that the FT was calling out today. Right, from the March 30 low, Alphabet's up 44%. Broadcom's up 43%. This is like in, what is this, 6 weeks, 5-6 weeks? Amazon 35, so Alphabet hits a new all-time high. Amazon hit one yesterday. Apple hits one today as well. You can be both durable and fragile, can't you? Malcolm?
I think that's the perfect way to characterize it. I think the FT is pointing at fragility properly, but pointing in the wrong place. Because I think this past earnings should have made people very aware of just how much we're on borrowed time, in the sense that you have 4 companies, it's Amazon, Microsoft, Google, and Oracle, whose backlogs that we now know are about $1 trillion combined. That's half of all of the backlog related to 2 companies, OpenAI and Anthropic. That's all coming from just those 2 companies' supposed pronouncements of how much they plan to spend. Those are only commitments and handshake deals. So when we do get one of those companies finally come public this year, probably Anthropic before OpenAI, it'll be our first opportunity to see just how likely they are to hit those targets as far as revenues are concerned. And I have a suspicion that it's not going to be what the street actually expects and wants to see. So all of what this is built on top of, between those 4 companies I just named, could come crashing down. So I don't know that we have 2 years like PTJ thinks it could extend to, maybe 1 year.
What do you think?
Listen, I think you have to remain constructive. I think this momentum, it's tough to fight an earnings boom. It is really tough to fight. And what it's done, and I heard Ken Griffin talk about this out at the Milken conference, listening to what he said to the group. And the reality of it is there's a derivative benefit of this. There is now a renewed focus and energy in technology among the executives at these companies. And what that leads to is a very virtuous cycle of investment and a rigorous focus on productivity and profitability. And I think we're at the very early stages, and those that are winning should be winning. They're laying the foundation for this. But there's a lot of winners that are going to come out of this in terms of that. And listen, there's questions about what's going to happen to the labor force. And we've shown a history of being able to redirect and re-rig and retrain labor to be able to take advantage of what's new. When the internet came out, there were no social influencers. There were no web designers. You know, there's businesses that are born out of these changes that are step changes in productivity. I'm gonna tell you something. These numbers are ridiculous. Q1 EPS is up 27%.
No, right. That's for the S&P. If you look at tech and comm services, you're talking about double the 27 for those groups. We're talking like 50-ish% for tech and comm services. Now, they've gotten a boost as well, as people have been writing about, which I think is interesting, too. These companies and their stakes in private companies, the OpenAIs,
yeah, but even
and the
after that,
and
you know, strip that out, it's still up 16%.
No, of course, it's been.
This is the build out, and during the build out, these types of eye-popping earnings growth numbers from box makers, hardware companies.
Yeah.
This could go on for years. We saw it. Like I think all of us on this desk can remember the original build out to the .com. It didn't start in 1999. It started in 1995. The Netflix IPO, I think, was it 95 or 96? So, like, you had a 4-year runway. And then the question becomes, at what point do the comps, this, 2028 versus 2027, is that where finally it's like, okay, we're still growing, we're still building this out, maybe it's at a slower pace, but we're not there yet. I think that was the point that Paul Tudor Jones was making. I think it's the right point.
I do too.
Yeah, but if I told you,
thoroughbreds. These are the thoroughbreds that are running, and each one of them's winning a different point of the race. And right now, it happens to be Alphabet.